In 2023, the Houston Rockets generated over $300 million in total revenue. They sold out their arena, signed massive sponsorship deals, and filled their stadium with screaming fans, but on paper. After paying the players, the staff, and the stadium maintenance, the team technically lost money. They operated at a net financial loss. Now, in any normal business, a loss is a warning sign. It means your company is failing. It means investors start running for the exits. But just 12 months later, the estimated valuation of that exact same team jumped by nearly $500 million. Think about that. The business became significantly less profitable. Yet the owner became vastly more wealthy. It makes absolutely no sense, unless you understand the hidden playbook of the world's most exclusive country club. By the end of this video, you will see exactly how the world's wealthiest individuals have turned the NBA from a simple sports league into the ultimate financial shield. We are going to uncover the hidden accounting loopholes, the real estate syndicates, and the media wars that make owning an NBA team the safest, most lucrative asset class on the planet, even if the team never wins a single game. But to understand how this illusion works, we have to look at what these billionaires are actually buying. Today, the NBA is no longer just a basketball league. It is a $60 billion global entertainment cartel. Most people look at a team and see jerseys, tickets, and hot dogs. They think an owner's wealth goes up or down based on whether their star player hits a three-pointer at the buzzer. But the smartest investors on Wall Street, they see something completely different. They see an asset class with a structural monopoly. There are only 30 NBA teams in existence. The supply is permanently locked. Meanwhile, the global demand for live entertainment is exploding. This artificial scarcity has turned NBA franchises into financial lifeboats for tech titans, hedge fund managers, and private equity firms. But why are they suddenly willing to pay $5, $6, even $7 billion for a single franchise? The answer lies in a secret financial engine that regular businesses are legally barred from using. When a billionaire buys a traditional company like a tech startup or a manufacturing plant, they are bound by the standard rules of capitalism. You make a product, you sell it, you pay taxes on your profits. But the NBA ownership model operates in a parallel financial reality. When a group buys a team, they aren't just buying the current roster of players, they are buying a legal structure that allows them to use something called the roster depreciation allowance. This is the ultimate legal loophole in sports business. The IRS allows sports team owners to treat their players' contracts like heavy machinery. Just like a construction company can write off the wear and tear on a bulldozer, an NBA owner can write off the depreciation of their athletes' skills over a 15-year period. And they can write off up to 100% of the purchase price. This means an owner can show tens of millions of dollars in paper losses every single year, completely erasing their actual cash profits on paper. But here is the real kicker. Those paper losses don't just wipe out the team's taxes. The owner can often use those losses to offset the taxes on their other businesses, their hedge funds, their tech companies, their real estate empires. Suddenly, owning a sports team isn't about making a profit. It's about creating a giant legal tax shelter. But if the team is just a tax shelter, where does the actual spendable cash come from? The answer is a beautifully constructed multi-layered revenue machine that operates even when the stadium lights are turned off. Let's break down the layers. First, there is local revenue: tickets, parking, $20 beers, and jersey sales. This is what the average fan sees, but this is actually the smallest piece of the modern pie. The real engine is national revenue. Every single dollar generated from the NBA's massive media broadcasting deals is split exactly 30 ways. Equally, whether you are the world-famous New York Knicks or a small-market team struggling to fill seats, you get the exact same check from television networks and streaming platforms. In 2025, that national revenue share alone guaranteed every single team over $140 million before a single basketball was even bounced. And that number is about to skyrocket. The NBA just negotiated a new 11-year, $76 billion media rights deal with Disney, NBC, and Amazon. Think about that. Tech companies are now entering a bidding war for live content because it's the only thing consumers won't fast forward through. The owners don't need to sell tickets to make money anymore, they just need to keep broadcasting, but with all this incoming cash, why are the operating costs so high to the untrained eye? Running an NBA team looks like a financial nightmare. Your employees are 22-year-old millionaires who demand hundreds of millions of dollars in guaranteed contracts. In fact, player salaries consume roughly 50% of all basketball-related revenue. Then, you have the luxury tax. If an owner spends too much money trying to buy all the best players to win a championship, the league hits them with a massive financial penalty. For every dollar they go over the cap, they might have to pay $3, $4, or even $5 back to the league. Some teams have paid over $100 million in luxury taxes in a single season just to keep their roster together. Add in the cost of flying a private team jet across the country 82 times a year, maintaining high-tech training facilities and paying hundreds of stadium staff. It looks like a recipe for bankruptcy. But this is where the genius of the system reveals itself. The owners have built a mechanism that ensures they can never truly lose. It's called the escrow system. Every year, 10% of the players' salaries is quietly held back in a third-party account. If total league revenues don't hit expectations, that money is given right back to the owners. The risk is completely shared. The upside is entirely retained by the billionaires. So, if the running costs are controlled and the revenue is guaranteed by tech giants, what happens to the value of the asset itself? It explodes. This is the concept of massive capital appreciation. Over the last 2 decades, the average value of an NBA team has grown by over 1,000%. That completely destroys the performance of the regular stock market, real estate, or gold. Why? Because an NBA team possesses the ultimate corporate moat, compounding network effects. As the league expands its footprint into India, Africa, and China, the global audience grows as the audience grows. Tech platforms pay more for media rights. As media rights increase, the guaranteed revenue per team goes up. And remember, there are still only 30 teams when a commodity is locked in supply. But global demand increases exponentially. The price goes up vertically. An owner doesn't care if they lose $5 million on operational cash flow this year, because while they were losing that $5 million, the total value of their franchise grew by $300 million. It is the ultimate long-game arbitrage, but no empire is completely safe. Even this bulletproof system faces a quiet, existential threat. The entire valuation of the NBA is built on the assumption that cable networks and streaming platforms will always pay more money for live sports. But what happens if the streaming wars end? What happens if tech giants like Amazon or Apple decide that live sports are no longer a profitable way to acquire subscribers? If the media rights market cools down even slightly, the guaranteed revenue engine cracks. And then, there is the human element. The value of a franchise is deeply tied to the cultural relevance of its players. If future generations shift their attention away from traditional 3-hour game broadcasts toward short-form social media highlights, the core business model changes forever. The league isn't just competing with baseball or football anymore. They are competing with TikTok, video games, and streaming algorithms for the limited attention span of the modern teenager. To combat this, the NBA is quietly shifting its strategy. They are preparing for a future driven by deep tech and global digitization. We are already seeing the early stages of virtual courtside seats in the near future.